The listed InvIT and operator of power transmission assets, IndiGrid Trust's unit price corrected to a low of 84 rupees a unit during the recent market correction. But it is one of those few stocks which recovered swiftly when investors realized that it had little to do with the crisis caused by the coronavirus pandemic. In our ideas for profit today, I will discuss IndiGrid InvIT's Q4 earnings as well as whether investors should keep this stock on their radar. Well, the company's operational assets clocked at 99.5% availability, which is a good sign and suggests that there are no disruptions, at least as far as the transmission utilities are concerned. Now, the company has been adding new assets through the inorganic route, utilizing its cash as well as through fresh funding. Now, during 2019, the company raised about 2,500 crores through preferential issue from KKR and GIC. It also acquired two big assets worth 5,000 crore rupees. Every new asset comes along with additional number of units, and thus profit and cash per unit mostly remain the same unless the margins really improve. Thus, the revenue and profits figures are really not comparable. Now, what is worth looking at is the improvement in EBITDA margins, which during the March 2020 quarter improved by 270 basis points on a year-on-year basis. Now, if you really look at if there is anything that investors really need to worry about, is the extension of the working capital due to the delay in payments from the power distribution companies, or DISCOMs as they are really called. Now, under the COVID-19 relaxations, the government has not provided any moratorium to DISCOMs, but definitely the late payment interest was reduced from 18% to 12%. Now, delays are already visible. If you look at the April and May months, the collection has been about 50% of the dues. Now, management indicates that historically it has been around 60% during these months. So, there is a difference of 10% over there. Now, nevertheless, the working capital will get stretched, but not as much as the market worried initially. The government has also announced a liquidity infusion of close to 90,000 crore rupees for the distribution companies so that they can really meet the payment obligations whichever they have during the months of the lockdown and thereafter. Now, the management has indicated that there could be some pressure, but it would be definitely marginal at this point in time. Moreover, it is well equipped to, whether it is the situation considering the strong liquidity in the books. The company is already sitting on cash and current investments of close to, say, 539 crore rupees, which is more than twice the size of the FY20 debtors of 246 crore rupees. Now, InvITs function similar to a mutual fund where the value of assets are divided among the unit holders and 90% of the cash flows from these assets is distributed to the unit holders. Mostly the cash flows are constant based on the internal rate of return of the project fixed at the time of acquisition. Now, this is precisely why they trade like debt instruments, which offer slightly higher yield. Now, the company has consistently generated cash and pays most of that to the unit holders, maintaining a dividend of 3 rupees per unit quarterly, which adds up to an annual dividend payment of close to 12 rupees per unit. Now, at the current market price of, say, 100 rupees per unit, IndiGrid is offering a yield of close to 12%, which is quite good considering the falling interest rates, predictable assets and constant cash flows. Therefore, investors can definitely look at accumulating this stock from a long-term perspective.